Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. This week, for something slightly different on the Moneymakers Investment Trust podcast, I'm talking to Gavin Lumsden, who for many years has been writing about funds and investment trusts for Citywire, the news and analysis website. And I think it's actually 24 years, is it, or 25 years that you've been doing this, Gavin, and you've decided to take a step back and think about doing some other things. So just explain to us why that is.
Oh, hi, Jonathan. Yeah, that's right. If I stayed another month, it would be 25 years. So I joined Citywire at the start of this century. And yeah, it's been a great experience. It's been hard work. It's been a longer experience, longer stint than I ever imagined. But I think when I joined from the Times, a lot of people were kind of querying that move. But, you know, there have been ups and downs. But actually, overall, to join a growing company, I mean, admittedly, the early years were a little bit, Reuters came in with some funding, I think around 2003. I mean, I'm not running the company at that time. I'm not a senior manager or anything like that. I'm just saying that was what was going on. And until then, I guess it was quite dicey as to if the company was going to prosper. But the funding came in and it did prosper. And I think overall, it's been much better to be part of a growing company than maybe at a newspaper that's, have to really struggle with the whole move online.
Yeah, it's been a very eventful period for the media, that's for sure.
Certainly has.
And you came in, of course, Citywire was one of the products of the TMG internet bubble in a way.
Yeah, we're .com survivor.
Exactly. And it's been very successful since then. Done a whole range of things. But you've done a lot of writing about investment trusts, and that's going to be our focus today. And of course, the investment trust industry has changed enormously over the years as well. Back when you started, apart from the TMT bubble, we had that important event in 1999 when investment trusts were allowed to buy back stock and hold them in treasury for the first time, enabling share buybacks to proliferate, if you like. And you also, I think, lived through the split capital crisis, the global financial crisis, COVID, Ukraine, inflation, all those things. So what would be your take on how the investment trust industry has changed over this period?
Well, I actually started writing about investment trusts and then had a long break, but I started writing about them in 95 when I joined what was Investment Advisor magazine at FT Magazines. And it was a rival to Investment Week, which obviously is still going. I know Investment Advisor, I suppose, is still going in an online kind of way at FT Advisor. So what made those two titles stand out? Obviously, they were aimed at investment advisors and to kind of indicates their commitment to covering investment. They did a lot of investment trusts. So I was covering investment trusts back then, and then moving on to the Times, covered them less. And then there was a big gap until I joined Citywire at the beginning of the century. And as I say, there was the splits crisis happening then. But in fact, my then colleagues, David Smith and Sunil Jagtiani, were doing a fantastic job at that time covering investment trusts. So I don't really get my teeth stuck back into them until about 10 years ago or something. But to answer your question, back in the 90s, investment trusts, it's virtually all equities, isn't it? So the whole expansion into alternative assets and non-equities and big expansion into property, but particularly infrastructure, all that was to come. So I think that's the main change because they've been the domain of active private investors for a long time. And that's expanded, perhaps, but that's a constant theme. But I think it's the changing expansion of the sector into outside equities, the biggest thing.
One of my reasons why I like investment trusts from the point of view what you and I do is that there's always something going on. There's always a news announcement every day from somebody.
Well, it used to be a real cosy backwater, didn't it? I mean, maybe still a little bit of a backwater sense, but you've got 300, 400 companies perhaps pumping out R&S and news on the stock exchange. So there's loads going on.
Do you think that the ability to ask questions of investment trusts or communicate with them has improved over the years? They were quite cosy backwaters, as you say. It was quite difficult to get a lot of information out of them. Has that been a change that you've noticed?
So when I resumed coverage of them about a decade ago, I definitely said, yes, that's a really big advantage. You've got monthly fact sheets, quarterly updates, and the whole stock market reporting thing was a positive compared to open-ended funds who, maybe are doing monthly fact sheets, but that's kind of about it, and don't have the same disclosure and don't have annual reports of the same, anything like the depth and all that sort of thing. So investment companies were definitely winning, and are still winning on that, still got the upper hand. But again, on the alternative side, there has been a creeping in of being maybe a bit less committed to full transparency. But I say, overall, you get loads more information about trusts and investment companies than you do about open-ended funds.
I would say that's definitely been a trend, certainly the last 20 years, maybe not just the 10 years. And of course, you have to spend a lot of time explaining to people how discounts work or why they matter or whether they matter. I remember Hamish Buchan, who was Wood Mackenzie analyst with Robin Angus back in the day, arguing that actually discounts don't really matter because the sensible people just buy them, whatever the discount is, and they hold them for a long time, and then the discount doesn't really matter at all. But it seems to be that's one of the things that catches the imagination of retail investors in particular, the idea you can get something below its apparent value anyway.
Yeah, the trading opportunities are just there for the fact that you've got the discount, and you can start looking at whether it's wider than average and whether it's going to narrow. And if it narrows, you kind of get a boost to the investment return. So it's a funny thing, isn't it? Because they're absolutely brilliant long-term holdings, which is Hamish saying to you, so irrelevant about what the discount does. I think it goes out from 0 to 30, that will have an effect on your long-term returns. But yeah, if you're a long-term holder, you're not too bothered about the discount. But then at the same time, they are pretty good, ideal for people who want to trade in and out and be a bit shorter term about things and take advantage of these pricing anomalies. And I guess I spend a lot of time catering to those kind of investors and readers with a weekly trust watch and just being quite discount aware. But yes, I mean, Hamish is right. In a way, it doesn't matter.
If you're a long-term holder, that is. But of course, there are people who aren't. Well, looking back over the last 10 years then, can you pick out any highlights of things that you found particularly interesting or stories that you got really involved in that were striking or pleasing?
Do you mind going back a bit further? Because this is one that Annabelle Brodie-Smith, Association of Investment Companies, who many listeners might know about. She often refers to my story that I was involved in. Was at the Times, as I was saying, after I left Investment Advisor, joined the Times in the last century and generally writing about trusts. But as she wants to remind me, I did a piece about the then Brazil Investment Trust. And basically, there was a big corporate governance row going on. And Michael Hart, who has just recently stepped down as the fund manager of F&C Trust, was having a fight with activist Hermes, who didn't believe it was correct for a board to be chaired by a former fund manager. And anyway, the Times wanted me to write a piece, and it ended up being a short comment piece. It ended up being very much kind of rewritten, because I was still quite junior and didn't know how to write comment pieces. But quite a negative piece came out, and Michael Hart ended up stepping down. He took this to heart, no pun intended, and stepped down at what's called the Association of Investment Trust Companies, now just simply the AIC. So that was having some impact, I guess. But I always did feel a bit bad about that, because I read out late afterwards that he was depressed and sad about that for some time. So misgivings about that particular story. But that is going way back. But I just mention it because Annabelle often mentions it to me, and I think maybe other people are aware of it as well. I'm attached to that departure.
Well, he had, of course, been manager of F&C, as you say, for a long time.
20 years or something.
Yeah, a very long time, and took over the AIC. But I don't think that was the only thing that made him a little bit unhappy. I don't know, but I've heard it said that he wasn't particularly happy in the role anyway. We'll see. If that salves your conscience at all.
Well, that's good to hear. That lessens my role in it anyway.
Yeah. Well, the media does have the power to influence things, that's for sure. Some of the stories we've had to write about in the last 2 or 3 years have not reflected that well on the investment trust sector, so I'm thinking of things like Home REIT or the Indian one, whose name I can't bring myself to mention. But that's been relatively rare, would you say? I mean, again, it's something the media likes to get involved in, but what lessons would you draw for those particular unfortunate episodes?
Well, it comes back to, the sector has expanded and let its guard down a little bit. I mean, Home REIT's just one example, but it is a terrible example. So inevitably, it leads to bad publicity. We can talk about that. But then if you do the comparison, you mentioned the splits crisis, or we referred to that a bit earlier on. Obviously the investment company sector is going through a tough time, and Home REIT is a blow to the reputation of REITs and the wider sector. And there should be more scrutiny by investors of the people involved. It floated at a time when people are feeling very optimistic, and these things happen. They're not checking what it's actually doing. So that is a bad one. But if you think about the sector and this painful derating that equity growth funds had and alternatives had when interest rates shot up and inflation shot up a few years ago, that fallout's continuing. Things look pretty bad. There hasn't been a float for ages. There hasn't been a new launch for absolutely ages, and loads of trust trading and wide discounts. You had the whole cost disclosure argument, which has been resolved, but seems to create another row over whether trusts have zero charges and that sort of thing. Anyway, if you compare it back with the splits crisis, that was really, really bad. And I was just looking up at the House of Commons report at the time. I think at the time the sector had 50 billion under management, of assets in investment companies, and 13 billion of those were in splits. So the splits crisis was really bad. There's bad governance, bad structure, and there was a lot of them. And now I think the worst sector in terms of discounts and the kind of worst de-rating is maybe around infrastructure. And there's no scandal there, unless you think maybe people were encouraged to pile in high and now are suffering at lows. But there isn't really a scandal there, not generically like the splits anyway. And what I was trying to do was put some numbers together that said, if you look at the infrastructure funds, they're like 10% of current total assets in investment companies. And then even if you did add in all the other alternatives, and then they all got wound down because people were so fed up with the wide discounts, you're talking over a quarter of the assets in the sector. Yeah, it's a lot. And then maybe you're getting onto a kind of sense of the threat that you might have had during the splits crisis. But I just don't think it's as bad as that, basically. And in reference to home REITs, that is a shocking scandal. But
Yeah. It should never have been able to come to market, frankly.
So the other problems we've been seeing, there's been other problems, but there's nothing on the scale of what we've been seeing at home REIT.
Yeah. I think we can see that in the context of the cycle, as it were. Hard to believe that 3 years ago, the average discount was 2% and lots of IPOs were coming from all directions. And of course, there'd be some quality issues there. And the ones that have come most recently have been the most vulnerable, I think, to setbacks. But maybe that's just the nature of the game. But I guess here we are, 3 years on, as you say, no IPOs. Average discount is still 15%. And that's obviously mainly concentrated in the alternatives, private equity and commercial property and so on. So there is a big challenge to the industry. But is your impression that the industry likes to say, well, what's good about us is we're a Darwinian process and the boards are getting their act together and they're taking action? Do you think that's true?
I think it is true, but of course boards are under pressure, so investors are pushing them. And so you're seeing a range of behaviour, missteps by boards like Smithson at the beginning of the year, or early in the year, when they tried not to hold a continuation vote when there had been a clearly signalled discount trigger, which was triggered. And that was fairly quickly changed their minds on that one. That was a mistake. But elsewhere, more recently, Finsbury Growth and Income announcing that they're going to hold a continuation vote, I think, the year after next. I didn't see that one coming. So I think, maybe that's an example of a board being proactive. Or maybe there's a whole ton of stuff going on behind the scenes we just don't know about. But it does look like there's a board that's trying to stay ahead of the game, but also responding to the fact that performance has been poor recently.
It's also interesting that following the news in the last 2 or 3 years, we saw the impact of activism in respect of Scottish Mortgage. Elliott Management coming in and effectively, I don't know what word you would use to describe it, but eventually kind of holding the board to ransom it away and getting a big buyback. And more recently, we've seen action at Hypnosis and 1 or 2 other places. And of course, then there's Saba Capital, which has been a very interesting story, which I know you've covered in some depth. I guess the question that many people are interested in is, we know what Saba Capital are trying to do. They've disclosed stakes in a number of trusts. They may have other holdings that we haven't heard about. But the question really is, what is their end game? Does anybody know what their end game really is? I know you've spoken to them, but it's a conundrum, isn't it?
It is a conundrum because they've been around a while, and the most manifest sort of example of conflict or direct engagement battle with the board was with European Opportunities, and that was at the end of last year. And since then, it's all been quiet, except it hasn't, because the various Baillie Gifford trusts that they're involved with have been announcing performance-related tenders, and one of them is merging. And so, I think you can see their influence at work, and I think they've been renewing their stakes and building them up quite steadily. So one that's caught my eye recently is Herald Investment Trust. So I was beginning to think that it was their strategy in sort of picking off smaller trusts, or maybe not small trusts, but ones that are run by boutiques, one trust firm. So like Alex Darwell at European Opportunities, and then Katie Potts on Herald. Saba's now at about 17%, and there's a continuation vote coming up April, May next year. So I won't be reporting on it, I don't suppose, but I'll be looking forward to see what happens there. The shares have re-rated and they're trading close to NAV. So, maybe the threat to a discontinuation in order to close that discount, maybe that's happened already, and therefore maybe the trust is safe. But it would be worrying to see a trust like that forced into a wind down. But who knows? They haven't said anything. They're just steadily building stakes in these kind of trusts, and it just makes you think about where it's all headed.
Yeah, that's absolutely right. So one of the issues, I think, for the investment trust sector is they've been very keen to develop their retail following. They want private investors to back them, and they concentrate now a lot of marketing effort on retail investors because the old institution's no longer there to buy the shares, and wealth managers are consolidating and all that. But of course, retail investors are not very well empowered to make changes when boards are perhaps not doing everything they can do. So I guess you could make the argument that you need someone like a Saba Capital or an Elliott to come along and kick the boards into some sort of action.
I think so. Take the example of Herald. Katie Potts has been running that for 30, 40 years. Great job she's been doing. Interesting global approach to tech that isn't all about the US. Quite a bit of it's UK. Really interesting trust, but really low profile. And, what's the succession plan, for example? I know she's got some co-managers, they've got an investment team there at her company, but are they really in the position to step up even when she retires, that sort of thing? Because the reason I mentioned that, just when it was more recently trading at a discount, you maybe could have said that was because of uncertainty over where Herald was going after all these years. So in that example, maybe there's a group or a trust that could be more explicit about what's happening. It's the same with Finsbury Growth. Nick Train, how long is he going to be running that for? I mean, he says he wants to carry on for some time, but he's been saying that for some time, and I think the clock is ticking on. So I think it's easy to portray activists as kind of antithetical to the interests of private investors. But there is some argument that their interests aren't always aligned. It's quite clear that private investors, for example, don't tend to participate in the tender offers that the value investors and the activists like to push for. It's just those kind of institutions that are buying in on wide discounts, pushing boards to do something, they do something and they buy back a whole chunk of shares in the tender offer, and it has a temporary effect of narrowing the discount, and then it widens again and they come back for more, and then ultimately you're in a vicious spiral, a downward spiral of shrinking assets and becoming relevant to the market.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. So one of the interesting things that I've been talking about recently was talking about enhanced income strategies that some boards have employed. About 30-odd trusts, I think, have enhanced income strategy.
I've been quite successful, haven't they?
They have been successful as far as I can tell so far, yeah. And one of the reasons that they say that's helpful is that, of course, it does benefit everybody in the trust rather than just some significant shareholder comes along and demands a tender, as you say, and takes money out for themselves, but it's not more widely spread for whatever reason. And that brings us on to platforms. Now, the platforms are very much in the spotlight at the moment because of their response to the cost disclosure issue, and, of course, other things that are going on in the background, like consumer duty, the new regulatory framework, and so on. What's your thoughts about that issue in the sense of platforms, A, insisting that investment trusts still send them the old cost figures in the so-called EMT when they provide data to the platforms, and secondly, in terms of stopping some investors from buying some investment trusts for various reasons that they put forward?
Well, on the latter, I've got very little patience with. I mean, it got to a point with some of these platforms where they were getting people to answer questions to prove that they were sophisticated enough to buy an investment company. And in others, they were saying that they were only for sophisticated investors. And in fact, they were kind of taking them off the platforms, effectively barring new investment because, well, it wasn't always entirely clear in the case of, say, Fidelity, but costs would be a factor. Now, here's a tricky one. And the platforms, I think, are interpreting their duties, that they're taking it seriously. And obviously, high charges, and some investment companies do have high charges, do reduce, obviously, the investment return the investors are going to get. But there's a couple of things that come out of that. And in terms of the kind of DIY investors who are up in arms when either they're being forced to jump through hoops or read ridiculous warning letters or notices that totally misdescribe what an investment company is about. That was in the case of AJ Bell at one point. Or in Fidelity, they're barring them from putting money in. Of course, some of those private investors are saying, well, I want to buy something on a discount. I know it's problematic. That's why it's on a discount. I don't think it's as bad as the share price indicates. So that's my decision. So all this other stuff, I know it's probably a bit pricey, but it's kind of, if you're buying something on a 20% discount and you have some faith in a turnaround or whatever it is, then you are a little bit less worried about what might have been called the total expense ratio. And things like that. It doesn't mean that, expenses and charges aren't important. They are, but just that you're looking at it in a different way.
Yeah, to be fair to the platforms, and I'm not sure that I particularly want to be fair to the platforms, but to be fair to the platforms, I guess they are concerned about the fact that in the past, when we've had things that have gone wrong, the retail investors tend to leap up and start complaining like mad because somebody has to be responsible, whether that's Harvey's Lansdowne over Woodford or whatever other case might be. And so to some extent, they do need to be protected from themselves, if you like. A good example would be I got a lot of messages about Digital 9, which everybody wanted to buy them because they were on a 70% discount. Well, that hasn't worked out so well for people. And that is perhaps a good example where you perhaps want to put some kind of filters in place. But as you say, on the other hand, it's a free country, so there still has to be somewhere that principle that if you want to lose money by making a bad decision, then you should be free to do so. So I wonder where that's going to end. Do you have any insight into when or how the cost disclosure issue is finally going to be resolved? We know we've had this period of forbearance and the FCA is, as usual, taking its time to decide what to do.
Well, we're supposed to be getting something from the FCA this year. So I wonder, you're making me think of this because we referred to splits, but I remember, I think it was the FSA back then, the Financial Services Authority, the predecessor. I can't remember what year it was, but it was many years ago, but it was sometime after 2002. It was basically when they made their final announcement, what they were going to do about the split scandal. Anyway, it was basically a Christmas Eve announcement, and me and a few colleagues in the Citywire newsroom at the time going, oh, thanks. Just about to head off to the pub, at 11 o'clock or something, on the 23rd or 24th of December, and you get this announcement. So maybe we're into a similar sort of maybe less nail-biting conclusion. So we'll get that, and then there's all the detail of the regulation and the consultation to be done. I mean, I have some sympathy with the platforms, and if we've got to change our technology, if we've got to do some IT work, we'd rather do that when we know exactly what we have to do, rather than just do an interim thing just to keep some campaigners quiet. But it is a huge issue that's blighted an entire sector, or vast swathes of a sector, so of investment companies which are bought through their platforms. I think it is in their interest to do something about it.
I've heard it said, I'm sure you've heard it said too, that there are people in the investment trust industry who think that the FCA is not very sympathetic to investment trusts. And that stems in part from the fact that, like all bureaucrats, they want to have standardization. They want to have the same regulation for every type of fund.
Yeah, I think there is something in that, but I think it's broader than that. I mean, it's more of an issue around DIY investing. So they want, or they think, that all investors should buy through a financial advisor, buy something under advice. And yeah, it's great to get independent financial advice. It's important to get independent financial advice. But as we probably know, actually, on the investment side, I want to get this right. I want to express this in the right way. But the DIY investors can have a much better go at investing, I'd say. That's a huge generalization. There's a narrow gap. They can make awful mistakes, obviously. But the diligent, self-educated private investor can do almost as well as the professionals on just trust picking, fund picking, stock picking. Where they need professional help, or where IFAs really come into their own, is around pensions and tax planning. Absolutely brilliant at that. And asset allocation and the big picture, and just having a discipline and setting up a process that you're going to stick to over the years. That's what financial planners bring. Anyway, so loads of people should take financial advice. Financial advice should be more widely available. But even if it is, or were to be, you're still going to get a proportion of people who want to do their own thing. And actually, they're particularly important for investment companies. So I think the kind of tidy bureaucrat would like a market that only went through intermediaries, and it doesn't.
Yes, and of course, it's fair to make the point that, as you said, most financial advisors don't actually know anything about investing at all, really. They don't really specialize in it. They look at financial planning and tax and so on, and they mostly outsource their investment management anyway to other people.
They outsource it to discretionary fund managers, yeah.
Exactly. So that's one that needs to be resolved. The second part of my question was going to be, do you think the platforms have an issue with investment trusts? Again, we've heard it said they don't make as much money out of investment trusts as they do out of open-ended funds. Do you think that's a factor? Are you prepared to take on the might of the platforms and say that?
I don't think that is fair. No, I mean, some time ago, Hargreaves Lansdowne, Peter Hargreaves made negative, caustic comments about investment trusts. I think the platform sector has moved on a long way from that. Yes, they may be making less money, but they're making some money. It's a significant part of the market, and it's a significant customer base. And different companies do different things, but no, the platforms are taking investment companies, investment trusts, much more seriously than they did in the past. So I think they're happy to have a spread of businesses. Funds may be more straightforward for them, not so sure. But they would be mad to turn their backs on such a well-established sector of the market as investment companies. And I don't think they are.
I think I agree with that, actually. But the other point I was trying to make was that if you want to standardize everything, and that's how European legislation started, you want all kinds of funds to be treated the same. But the problem being that investment trusts are actually half a fund and half a share because they do trade in the market. And therefore, you could argue that they require their own bespoke regulatory environment, which we may or may not get. Let's put it that way. I'll go no further than that. Now, obviously, if you write for the media, perhaps not everybody knows this, but there are a lot of rules governing what you personally can invest in. So perhaps you could remind us what those rules are and how far you're actually able to capitalize on your great knowledge of the investment trust sector that you've accumulated over these 24, 25 years.
Okay, well, that's a lot. So Citywire, well, I've worked mostly, is not a regulated firm, so there are relatively few rules. So the main issue is around personal trading and disclosing that. So on a practical level, we have a pension provided through the company, and it's a self-invested pension. So at varying speeds, people get more and more interested in choosing investments for that SIP. And basically, if it's a share or an investment trust, we have to tell someone, if you're editorial, that you're buying it and not write about it for a few days afterwards. If it's a fund, there's no problem. But it's good practice, if you're a journalist, to tell the same person that you bought it.
That's absolutely right. And it was amused in the past, that's for sure, by some people. I mentioned no names from the glorious past of financial journalism. But that was not always the case. So it's good that that has happened. So how would you describe yourself as an investor, looking back at your SIP and everything else that you invested in?
Yes, I was slow to get going over my 25 years. First few years, not taking advantage of it, and then kicking myself and getting going. And I mean, I'm talking about like 20 years ago, started really paying attention to it and investing it largely in funds. And then about 10 years ago, when I started writing about trusts, putting more and more into trusts, all that was going quite nicely until about 2021. And then by that point, my pension would be almost entirely investment trusts. And one of the big holdings would have been Scottish Mortgage. Like a lot of journalists, like a lot of investment journalists, like a lot of the public owned shares in that. So I found the growth sell-off and the move from growth to value really quite challenging. So I basically moved to a financial planner, or basically took on the services of a financial planner whose mortgage broking arm I've been using for many years, and actually started using a financial advisor properly for the first time. And the result of that was that they use a platform. They use 7IM as a platform. And their main thing they do is they run portfolios, and they don't invest in very much investment trusts. So I had a difficult decision. So I've partly moved to their portfolios, and I've reduced my holdings in investment companies. But I've still got some. I've still got about a third of the pension in trusts. And the benefit of that is that a professional is looking after the asset allocation and making those calls. Because I found those calls, like when to move from growth to value and vice versa, is just really difficult. And at that time, it had massive implications for your returns. So I hung on to Scottish Mortgage too long, and then you just watch it drop like a stone. So I went all the way up in the investment trusts, and then I've reduced. And I'm just thinking, I don't want to reduce too much more. But it's been an interesting eye-opener to see how the kind of financial advice system is good in many ways. I'm getting good advice. I've got someone who's on hand to answer queries, and we have regular reviews, and all that's good big picture stuff. But yeah, my favourite investment companies have been squeezed a little bit. I'd rather have more investment companies because I do think they're good long-term holdings, but my advisor isn't so keen on them, basically. So we've reached a bit of an accommodation where I've got fewer of them. But yeah, so that's my position. I've still got Scottish Mortgage. I've got AVI Global because... So for me, I'm writing about the discounts and pricing anomalies and all this sort of stuff. And the managers at Asset Value Investors, that's what they do. I mean, they don't just buy investment companies. They also buy holding companies. But they buy things that trade at discounts. And I just kind of think, particularly for me, that's like a good one-stop exposure to private equity funds that always seem to be trading at wide discounts. Or something like Chrysalis, which... that was a bad story from 2022 and 23, wasn't it? But they bought into the recovery quite nicely and have pushed for improvements as well. So that's an important holding for me. And I still got Henderson Smaller, which had a terrible time. But hopefully it's pulling through. For me, that's really quite a long-term holding. So that's kind of where I am. I was all investment trusts, and now I'm a bit of both. A bit of funds and trusts again. But I'm now fully advised. So swings and roundabouts.
So now we know why discounts are widened, because the Lumsden pension has been selling investment trusts. That's obviously the main factor.
Well, maybe if that was writ large, maybe as financial advisors expand their assets on platforms and expand their customer base, maybe that is a headwind against investment companies. Clearly, there are advisors who do investment companies, but this particular one that I was involved with I mean, some of their portfolios do hold the investment companies, like some of the Indian trusts, but it's kind of here and there, not a big part of their investment setup.
So my final question really, Gavin, is going to be this. You're going to take some time out and you'll come back to doing some writing, I'm sure, in due course. But what do you think the outlook for the investment trust sector is? What will be your personal hunch now that you're not having to follow it day to day? But if you step back and think about it a little bit, do you think it's going to carry on shrinking, but it's going to get better quality? Are we going to see more consolidation? All those kind of things. What would be your opinion?
Yeah, I think we're going to see more of what we've seen this year, more in MA, because what surprised me, but I think is evident, is the fallout from the big derating in 21 and 22. That continues. So that raises issues around corporate governance. It raises issues about M&A. There are too many funds, too many investment companies. A smaller, leaner sector would be better in terms of numbers, fewer, bigger funds on the London Stock Exchange. Of course, that is easy to say and a lot harder to achieve, particularly like the renewable infrastructure funds. You know, you're just thinking they're trading so cheaply. Why doesn't one of the oil giants come along and buy the whole lot?
Yeah, this is a good question.
They just say that's how we're going to do with the energy transition or whatever. But in terms of knocking those kind of funds portfolios together, that's really difficult because they've got just completely different assets. So it's not like merging equity portfolios where there might be overlapping holdings, or it's very easy to sell legacy holdings that you don't want and buy the things you do want. So I think there'll be more of the same. Yeah, where does the sector go? So as I was saying earlier, if you compare it to the splits crisis, well, the sector bounced back from the splits crisis eventually. Those were the dark times. A lot of people had done things that were really, really wrong, structurally and kind of individually. But the sector recovers from that. Yeah, as you said, markets have been cruel at times, financial crisis, because that's not an investment company specific issue. And we haven't had big scandals apart from there have been individual things like home REIT, but nothing sector-wide. We have had this big derating, and a lot of people who did very well at investment companies are now feeling much sorer about their returns. And that raises issues around governance, regulatory oversight, and kind of investor behaviour, investor information, and the tendency of people to buy high and sell low and all that sort of thing. But it's not a scandal. It's a structural thing. You know, are multi-asset funds going to return to investment companies that they sold out of? I don't know. But even if the sector, as I was saying earlier, did retrench and just pulled out of all the alts that it moved into, you'd be left with the old sector you had before. These global trusts and these UK equity trusts, they go back well over 100 years, as we know, in many cases. And I don't see them being abolished at any time soon. So I think this sector may well retrench more, but I think fundamentally it's got its investor base and it's got its reason for existing and will pull through.
So that was Gavin Lumsden, stalwart reporter on investment trusts over many years for Citywire and elsewhere. We will be back with another edition of the Moneymakers Investment Trust podcast in the next few days. Thanks for listening.
The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.